Hello everyone and welcome to our webinar. This is professional real estate investor David Campbell, and today's topic is chasing infinite returns using real estate investor financing. Joining me today is financing strategist from Prime Lending, Graham Parham.
Good morning everyone, how's everybody?
Graham has been a financing professional for over 15 years. He has over 22 years in sales, marketing, and customer relations service. And he's one of the top mortgage producers in the Dallas-Fort Worth market. And I'm very, very grateful that Graham is able to help all of our investors at Hassle-Free Cashflow Investing get their residential financing needs met. And I have had nothing but glowing comments from everyone who's worked with Graham. So Graham, thanks for joining us today.
Oh, you're welcome, David. Thanks for having me.
So what today's call is, it's about relationships, ideas, and opportunities to help you create more passive income and to create abundance in your life. Today is not a sales opportunity. There is nothing for sale. We do sell investment property. We do talk about investing ideas. We may talk about tax ideas and legal ideas, but this is not legal, tax, or investment advice. And if you're looking for that kind of advice, please consult with the appropriately licensed professional. So today's agenda: how to prepare your balance sheet and your mindset, and really how to get in position to getting real estate investor financing. We're also going to talk about some creative strategies that you might not hear other places on how to really work within the framework of the lender guidelines to get your loan done. And if you know what the rules are, then you know how to use those rules to work in your favor and to get the kind of financing that you're trying to get done. We'll also be talking about investor strategies so that you can learn how to buy more income property. And we'll be talking about arbitrage, or how to make money on the bank's money. And we'll learn some rules today about how, some hard and fast rules about leveraging positively or leveraging negatively, and so you know how to use debt more effectively. We're also going to talk about using even small amounts of equity to go out and buy more property. And if you're one of those investors that bought a property and is now over leveraged, Graham is going to give us some great information about the HARP program, which is a federal government program to help you take advantage of today's low interest rates. So Graham, could you tell us about Prime Lending and the power that Prime Lending brings to the market?
Absolutely. Prime Lending, we're a locally based company here in Dallas, Texas. We've been around for 25 years. In 2000, Plains Capital acquired our company, which is a great thing because they infused a lot of money to our company to the point where we don't need mortgage lines of credit with other firms that may or may not cut us off. We always have a strong financial backing, which means that when we have high volume months, especially in this particular photo, you'll see that we did $8.7 million last year. Well, you have to have a lot of capital to fund that many loans. It looks like we're going to do probably a little over $11 million this year. The company itself, it's one of the largest privately held banks in the Texas area. As far as the retail production, and that ranks us up against the big boys, the major thrifts, the Wells, the Chases, and so forth. We do have a financial division, which we manage some assets and so forth. The key to this is that we're owned by a nationally chartered thrift. And what that allows us to do, that we can do lending in all 50 states. I personally can lend in all 50 states, where other loan advisors or loan consultants that work for maybe a brokerage shop or possibly a mortgage banking facility, they have to be personally licensed in all 50 states. Being that we are owned by a nationally chartered thrift, we do not, so we have the ability to do business in all 50 states.
That's a huge advantage for our investor clients when they're developing their team, because the financing professional is one of the most important team members. You can take them with you from transaction to transaction. And also, after you buy the property, the broker that helped you buy the property may be very helpful in the beginning of the transaction, but the financing professional that you developed a relationship with, they can hopefully be with you for your entire ownership of that property, and the multiple refinances when you go to sell, getting the buyer who's buying your property, a qualified financing professional can make your job easier when you go to resell.
I agree, David. And one of the benefits of that is that, as let's say somebody wants to acquire a property in Texas, we go through the whole mortgage process. I gather all their documentation, and then they call me back and says, I've noticed rates are low, and I live in California. Can you help me there? Well, absolutely. I have all your documentation. You just tell me when and where. And if they want to move to another state, same example. So, kind of keep it focused into one originating source where they don't have to go through the whole process over and over.
That's so important in really investors who are trying to create a hassle-free investing experience. Very candidly, there's no such thing as hassle-free in real estate, but we could definitely go as low hassle as possible. And one of those ways to reduce hassle is by making that financing experience simpler and easier. And when your loan originator has all your documentation and you decide to do 4, 5, 6 loans, it can really make that document acquisition and delivery process a lot simpler. So when we're talking about why financing in the first place, why is today's real estate market so good? And one of the answers is financing. That rates are just so low that it's a great opportunity to get into the market. And as a real estate investor, the way that I think about financing is I want to create arbitrage. I want to make money on the bank's money because I only have a limited amount of funds, whether it's $1 or $1,000,000. My personal funds will be limited, but my ability to borrow is potentially unlimited. And so if I'm trying to chase infinite returns, one of the important things, one of the important strategies to learn is how to create arbitrage. And today we're going to be talking about positive arbitrage and we're going to be talking about negative arbitrage. So rule number 1 of hassle-free cash flow investing is that your cap rate, which is the property's ability to generate income, the cap rate must be higher than the interest rate. And to just give you a general idea, the idea is if you could borrow all of the money that you wanted at 6% and you could go invest it at 7%, how much money would you want to borrow? And the answer is probably all of it. If I can borrow money at 6 and invest it at 7, you're making a 1% profit on the bank's money. And so if you reverse that equation, you say, well, I could borrow at 6 and I can invest at 5. How much money do you want to borrow? And the answer is every dollar that you borrow, it makes your return lower. It makes your return smaller. So when we're working with financing, some people are mistakenly afraid of financing. They think that it's they want to own their properties free and clear because they know someone who lost their property in foreclosure. And like any tool, a knife can be a dangerous weapon to hurt people, or a knife could be a very useful tool in the kitchen to cut your meat and your bread with. So it's not the tool that is problematic, it's how one uses that tool in their investing. So when we're working with the rule, cap rate must be greater than interest rate, the idea is that we can create infinite returns. If a lender was willing to lend you all of the money that you needed to buy a property, and it was still positive cash flow, you could buy an infinite number of properties. So when we're working with financing as a tool, the tool can either be helpful or it can be harmful to your return. And so here on the screen, we've got an example of a property whose performance is without financing. It's just owned free and clear. And as you could see, at a $100,000 purchase price and a 6 cap rate, it's producing a net operating income of $6,000. And there's no financing cost. And so what you get to keep as an investor is $6,000 on a $100,000 investment. So your return on investment is 6%. Here is an example of negative arbitrage. Negative arbitrage is where you didn't follow the rule of the cap rate being higher than the interest rate. You got it backwards, that your interest rate's higher than your cap rate. So in this particular example, you borrowed money at 7% to buy a 6% property. And you can see your net operating income minus your interest cost results in a small profit, only of 2% of what you invested. So you're able to get into the property with less money, but your return on investment went down. Here's an example of positive arbitrage, which is the income on the property enhances the return. So the more money you borrow, the higher loan to value you're able to get, the higher your cash on cash rate of return is. And that's the most important thing, is when you compare all three examples on the screen, the property stayed the same. It's the exact same house, but investor 1, 2, and 3 in this example have different performances on their money because they used a different financing strategy. In the positive arbitrage example, because the interest rate is below the cap rate, the more money you borrow, the higher return that you're going to make. Ability to get financing is an asset. There are a lot of people that their primary value add is they can bring a signature on a loan to an opportunity. And so when we look at the essential resources of cash flow, credit, equity, those are the things that the lender is going to look at to see whether the property is suitable for a loan or not. The creative part of our talk today is that not all of those resources have to come from the same person. It's very possible that maybe you have the cash, but you don't have the credit, and so you can bring on a credit partner. Or maybe the opposite is true. Maybe you've got the income and the credit, but you have no money for a down payment. The deal needs all of these resources, but you don't have to put all of them in. So, for example, one of the solutions would be finding a credit partner. The other could be working in syndications, where you find a general partner and they can accept your cash and the general partner signs on the deal. The other is potentially even looking for private financing. I was very fortunate recently. I found a house that was a 10 cap house, and it was in a very rural market, and the house is older, and that was one of those reasons why the cap rate was higher. But I was able to borrow money from a private investor at 9% to buy a 10 cap house. And in this particular case, I was able to get 100% financing on the house because it was a private lender. They had no requirements for me to have any money in the deal, and they didn't look at my credit or my debt to income ratio. They really just looked at the property itself. Was it a good loan to value? And I bought it below market value, and so I was able to get 100% financing and have a cash flow. And those deals are very rare and few and far between, but it's a strategy for you to be able to get financing even if you don't have credit, even if you don't have cash or income. If the deal is strong enough, the money will find the deal. The other resources are what I call the below-the-line resources of time, your talent, your strategic relationships, and control of an opportunity. If you can put a deal together and you get to be the quarterback and you get someone to put up the cash and someone to put up the ability to get financing, and you put those all together in a deal, oftentimes by being that quarterback, you get to keep a piece of that transaction. And so when you start to get creative and you're working with multiple people to get a deal done, it's very important to work with a financing professional, a loan originator, who really can help you engineer the transaction in a way that it's going to get done and in a way that is legally compliant. And so it's good to have a mortgage officer to say, hey, Graham, I'm trying to put this deal together. Could you help me understand what's allowed? Help me understand the rules of the game so that I know how to play. So let's talk about the financing triangle and what lenders are looking for so that you know the rules of the game when you're trying to get financing. The lender is going to want to see income, they're going to want to see credit, and they're going to want to judge the collateral. And the collateral piece is easy to talk about. When you're buying a house in a very strong market, a lender oftentimes is going to go a higher loan to value. When you're talking about an industrial property in a very distressed area, a lender doesn't like the collateral and they're going to make the loan very low loan to value, or they might not make it at all, right? So when you're strong in at least two of these areas, a lender might compensate and give you a little bit better. For example, in my hard money loan example, The collateral itself was very strong, and the income from the property was very strong, so they didn't look to me and my credit in making the deal go. They were looking at the property and the property's income. Graham, can you talk about this financing triangle and how at prime lending, when you're working with conventional borrowers on conventional loans, what conventional lenders are thinking in each of these aspects?
Let's just talk about the collateral piece. In the commercial mortgage lending environment, like you said, the lender focuses primarily on the income that's being generated from the collateral itself. They want to see the quality of the collateral, and that's how it's judged as far as underwriting is concerned, more so than in the Fannie Mae, Freddie Mac world, where we focus primarily on the borrower and not so much as on the property. Yes, we want to get an appraisal on the property. We want to make sure it's habitable, and we want to make sure it has the value in accordance to the contract. But it's a little bit opposite of what the commercial lending divisions will do.
So in the collateral example, one of my favorite states to buy rental property in is the great state of Texas. And Graham, are you seeing that lenders will give you a higher loan to value loan in a strong economy like Texas compared to the same type of house in a weaker economy?
Over the last 4 years with this mortgage meltdown that we've experienced, the lenders, Fannie Mae, Freddie Mac, they've all gone out and done some judgmental reviews and reports in each of the markets. And some markets are considered sand states, like Arizona, Florida, parts of California, where if we went into that particular area and we want to do lending, and it's considered a distressed area, they may counter the loan to value maybe 5%, but we'll still do the loan. As an example, if you want to come in with a 20% down and we find that it's in a distressed market, it's kind of give us some red flags in underwriting. The underwriter may come back and say, well, let's make it a 25 or let's make it a 30% down. Typically, it's no more than 5%.
So a lot of investors, I notice, are really excited about going into distressed markets because they're focused on the price. But today's webinar is really about what financing can do to enhance your returns. And as we remember that previous slide about being positively arbitraged, if you find a property that's positively arbitraged, the more money you borrow, the higher LTV you get, the higher your cash-on-cash return is. So we know that financing can increase our yields, and we know that financing is a powerful tool. But Graham, there's something special about the time that we're in right now with regard to interest rates. And could you just share how amazing today's interest rates are?
Well, anybody that's keeping the ear to the ground, they're financially savvy, and they've seen that interest rates over the last several years. It just keeps going down and down. It's crazy. I've been working with investors for over 15 years, and one of my larger investors, he's probably got 200-300 doors, and he's been investing since the early 80s. So if you take a look at that chart and see the interest rates during the early 80s, I mean, they were in the teens. So one of the things that I know that this gentleman told me once, he says, you know what, anything below 7% is still a good rate as far as investing is concerned. You know, and here we are close to 4% today. It just makes so much sense to take advantage of these interest rates.
Having a 30-year fixed interest rate at 4%, which is today's interest rate, is an asset. When you are a landlord and your debt is locked in at 4% and all the competition around you has to borrow money at 5, 6, 7, 8%, think about your ability to compete in that marketplace. So let's fast forward 10 years from now and you've got debt locked at 4% and the prevailing rate has moved to 7 or 8%, which is a historical norm. Your cost of borrowing is about half that of your competition. And what a huge asset in your ability to cash flow your properties. One of the other great things about housing and investment in housing is the ability of housing to track with the consumer price index or to track with inflation. So as the whole basket of consumer goods gets more expensive, as gas goes up, as milk and bread and butter and all of the things that go into your daily life get more expensive, housing gets more expensive. Rents go up, home prices go up. And as you can see, housing has tracked with the consumer price index until recently. And what you can see here is that housing had a little bit of a bubble where it outpaced the CPI, and then it's had a regression where the CPI has outpaced housing. And so housing relative to other goods is on sale. Housing compared to gasoline, housing compared to milk, housing compared to all of the goods and services that you use in the economy, housing is a lower percentage of your overall budget than it used to be. And that means there's room for the price of housing and rents of housing to go up. That's a great opportunity, a great buy signal for investors. And this is just a very unusual time in history where you can get long term 30-year fixed interest rates at historical lows and buy real estate at prices that are at historical lows. And it's just a great time to buy. I've been waiting for this time in the market cycle to come, and it's here, and it's an opportunity to go buy as much as you can. I mean, Warren Buffett has gone on record saying the best investment vehicle is to go buy as many single family homes as you possibly could. There's some logistics to that, and one of those is financing. We just simply can't get hundreds of single family loans at cheap interest rates. There's a technical limit to that. So Graham, I'd love for you to talk about what some of those technical restrictions are, like what's preventing us from getting 100 different single-family loans, and how can we get as many loans as possible while prices are low and interest rates are low at the same time?
Great question. Before the mortgage meltdown in 2007, we used to have Alt-A paper available from New York and other resources that allowed for to go beyond the Fannie Mae and Freddie Mac requirements that stops us at 10. As an example, I've got 14 properties, but unfortunately I'm dead in the tracks. I can't get any more conventional lending, whereas before, you know, like a Merrill Lynch or Smith Barney or whoever was offering these programs, they didn't have any caps or limitations on the number of. They just would provide you, okay, we'll give you another 6, another one will give you another 4. So that was the great days before the meltdown, and unfortunately in today's environment we're dealing with more constraints, and we're primarily dealing with Fannie Mae or Freddie Mac. And what took place back in 2007 is that there was a knee-jerk reaction from both Fannie and Freddie and said, well, let's lower those thresholds from 10 to 4. And then when they did, probably 8-10 months later, Fannie says, you know, that doesn't make a lot of sense, let's take it back up to 10. So Freddie Mac never follows suit on that. The problem that we see is typically most of the big lenders, the big banks, usually like to have 2 buckets to deliver their products in, obviously one being Fannie, the other one being Freddie. So because they only have one resource, most of them, I'd say 99% of them, stop you at 4, where we have the ability to sell directly to Fannie Mae, so we have the ability to go beyond 4 up to 10. So in this particular slide, let's just talk about the 1 to 4 categories and what's available. In the 1 to 4 categories, you can do a 20% down on a single family times 4, and keep in mind we're going to count your primary residence against you if you have a loan against it, so you have the ability to buy 3 more. The big banks do stop at 4, and we have the ability to sell these loans directly to Fannie Mae, so we use their guidelines. And they do allow for a 5 to 10 loan category. Some of the guidelines are changed a little bit. As you can see, the down payment requirements now are 25, whereas the 1 to 4 was 20. And one of the changes from the 1 to 4 that the credit requirements are 720, and that is a hard stop. And the other changes are the cash reserves are 6 months on all properties, whereas before it was 6 months on the subject and 2 months on every other property. In this case, we do have to have 6 months reserves for all properties. And I want to stop and talk a little bit about those reserve requirements, because this is where a lot of times people don't know if they have it or not. As an example, let's say the cash to close on the transaction was $20,000, and they had, say, $25,000 in the bank, well, and they had 3 other properties. Well, then they didn't have enough cash reserves to, at least liquid cash reserves, to support the reserve requirements. But they did have a SEP or an IRA or 401k that allowed for to take money out of that account. So we just get documentation from that administrator of that fund to say, yes, this client does have the ability to take those monies out. That'll cover your reserve requirements. And that's where a lot of people get confused on. And once again, the HELOC funds, those are supported, and there is no gift funds.
So let's talk about the credit part of the triangle, because a lot of people who are trying to get financing, they want to know how do you look at my credit profile in a way to determine if I'm qualified to get a residential loan, both an owner-occupied property and a rental property?
Well, oddly enough, the credit score threshold in the conventional world that we work in today is at 620 on both owner-occupied second as well as investor. So that's the minimum. If you don't hit the 620, it is a hard stop. As far as credit profiles, we do take a look at that, but the information that's provided on the credit report, any liabilities and debts that are there, are funneled back into the transaction, where we take a look, as you see on the income part, the DTI, that's the debt to income ratio. We want to make sure that whatever current debt that you currently have, in addition to the new debt provided by the new acquisition, that those numbers are in line with the debt to income ratios. And typically we like to see those back end ratios no more than 45%. Ever so often we'll see a variance, 47, 48, but typically 45 is a threshold, as long as the numbers line up.
A lot of people talk about back-end ratios and front-end ratios, and I want to make sure that no investor is left behind. Graham, could you give us a very simple explanation of what a front-end ratio is and a back-end ratio is for financing?
We take the borrower's gross monthly income, and the front-end ratio is what the housing debt would be, so that gives us one number. And then we take the gross monthly income, and we take the new housing debt in addition to any other debts that the borrower may have, whether it be another house, credit card debt, car debt, any installment loans. That all goes into that one number. Typically the front end number is usually much lower than the back end number, but the back end number is still the most important one.
Graham, a lot of our clients and listeners, they have good credit. They might be in the 700s, but they had some short sales or foreclosures on their recent credit history. I know the answer probably changes over time, but as of the date of the recording, how long does someone have to wait from the date of a foreclosure or a short sale before they can get a Fannie Mae Freddie Mac loan?
The pre-foreclosure and short sale is 2 years with a 80% loan to value, 4 years with a 90% loan to value, and 2 years with a 90% loan to value for extenuating circumstances. So it varies by loan to value, it varies by extenuating circumstances. And that's short sale only, that's not bankruptcy. Like Chapter 7 or Chapter 11 bankruptcy, in writing it's 4 years, but they will do 2 years with extenuating circumstances. In Chapter 13, it's 2 years from discharge and 4 years from dismissal. Once again, 2 years if you have extenuating circumstances. So it really is case by case, but those seem to be the threshold and the minimums in today's environment.
A lot of clients that I speak to in a financial strategy consultation, they owe so much more than the property is worth. I was talking with a client the other day who owed $700,000 on a property worth $300,000. And I asked them, in 2 years from now, what do you think that property is going to be worth? And they said, maybe 320, maybe 350. And I said, so if you were to do a short sale on that property today, spend the next 2 years healing your credit, and you were to buy a virtually identical property to that 2 years from now, you'd be buying it at 350, and you would have had a $350,000 of debt relief. Right? You'd be $350,000 improved in your overall net worth. Obviously, there's some personal questions, whether that's something that you want to choose to do, how that would impact the rest of your credit, how that would affect your personal income taxes, etc. But from a pure real estate investing strategy, it's only 2 years from the date of short sale till they can go back and put 20% down to buy that property again. Does that sound about right?
That is correct. One of the things, as an example for round figures, let's say that they had an $80,000 mortgage left and they short sold it for $60,000, so they had a delta there of $20,000. Well, the people that are doing short sales are already in a desperation mode. They're willing to just let the house go. But what a lot of times they don't understand is that $20,000, that creditor, after it's sold, is still putting that $20,000 back on your credit, which is going to be accounted against you. So you have to be careful with that as well.
Yeah, so that's a great point in favor of cooperating with a short sale rather than just putting your head down and letting it go to foreclosure.
Exactly.
So let's let that be a segue. Graham, tell me, if I have a foreclosure on my credit, how long, assuming my debt to income ratio is good, assuming that my FICO is good, how long from the date of foreclosure before I can get another conventional loan?
The guidelines state 7 years, but they will do 3 years with extenuating circumstances.
So in the back to that story of the gentleman that owed 700,000 on a house worth 300, I asked him, so 7 years from now, what do you think your house is going to be worth? And he said, maybe $500,000. And so in that case, even if he let the property go all the way to foreclosure and he waited 7 years to buy that property back, he would have had an improvement in his net worth by making that kind of decision. Obviously, I'm not advocating walking away from your debt. I'm not advocating short sale or foreclosure. I'm just encouraging you to look at the opportunity cost on your credit. A lot of people say, I don't want to do a foreclosure, I don't want to do a short sale because I'm trying to preserve my credit. And my response to them is, if they're not monetizing your credit now, if you're not using your credit score to do something productive as an investor, then you're spending a huge premium, and in some cases hundreds of thousands of dollars, to preserve that credit score, when if you ultimately want to own that property, you might just claim a reset button. Let me get my clean on my debt by doing a short sale, wait the 2 years required to get back into the property, and you might be financially ahead. You have to run your numbers, and no one has a crystal ball that'll give you the accurate answer to that. So, Graham, we talked about the property, we talked about the credit part of the triangle, and we briefly touched on the income part of the triangle. Tell me about the cash reserves. A lot of my clients have the credit, they have the income, they have the property, but they don't have the down payment. Tell me, how can we get someone working with a credit partner or a cash partner, etc., to get conventional financing if they don't have the down payment?
There's several different ways that investors over the years have tapped into other resources besides their own liquid cash. They may be short on liquid cash and all their money's tied up in an IRA, or it's tied up in the equity of their home, or they just don't have the money. As an example, a lot of folks that I know, like say in California, that still are fortunate to have a HELOC that hasn't been exercised. That's an excellent source for down payment, because that's your equity. So we look at it as if that's your funds. So if you need 20% down on a $100,000 property, and you need, let's just say you need $20,000 plus closing costs, we can let you go and tap $25,000 out of your HELOC. We're going to count that debt against you, which is probably not going to be a problem. But as far as the cash is, we can allow that to happen. Other ways is you can take loans against your 401k because it's still your money. A lot of the 401k providers usually have limitations on what you can take loans against. A lot of times it's usually no more than like 50% of the actual asset itself. And another way is if you want to bring in a partner that actually has the capital where you don't, and they can be a borrower co-borrower scenario. We can utilize their cash money versus you, as long as their credit earnings and assets tied to your credit earnings and assets still manage to give us good FICO scores and good debt to income ratios, and that'll help us on the cash.
I think it's so important for people who are considering using creative investing strategies to work with their mortgage professional based on some scenarios, to say, here's what I'm trying to get done. Can you help me comply with the financing and underwriting rules to make this happen? For example, once upon a time, I bought a property and I needed just a short-term bridge loan. And so I went to a family member and I said, could you loan me the money to do this deal? And if I had just gone to them the week before closing, Graham, tell me what kind of problems I would have had if I had a sudden influx of cash the week before closing of a loan from a family member.
Good question. On an owner-occupied transaction, that would not be a problem because we would consider it a gift. on the non-owner occupied properties, investment properties, gift transactions are not allowed. So what we do is we take a look at 3 categories as far as your credit, earnings, and assets. Now the assets, we took a look at the last 60 days of all your liquid assets, whether it be a checking account, savings account, some sort of liquid tool, and that, like mutual funds and so forth. And as long as those funds look to be relatively stable without any influx of deposits, then we shouldn't have a problem. Now, if you are expecting to get those monies from your parents or another source, then the only choice you have is to put those funds in that account and let it season for 60 days, so it won't, when we look at your bank statement, we won't see that influx of a large deposit, so it won't be questioned.
Graham, tell me about whether their loan programs are available.
Now, cash out refinancing on investment properties, it can be tricky. The guidelines in most recent day for most lenders is at least 6 months for a seasoned, or should I say a quasi-seasoned, that's the way I interpret, because in the 6 to 12 months you can refinance your product that you bought. If you bought it for $100,000 and you put $20,000 into it, we're only going to loan you against the price that you bought it at the $100,000. We're not going to give it to you at the appraised market value. Whereas on the seasoned cash out, which is 12 months, that's where they do allow you for full value with appraised value. Just recently, in the last, I don't know, 8 to 10 months, Fannie Mae came out with a non-seasoned product where this really comes into play to help you with that equation that you were talking about early. Somebody might have had an exchange, they needed to spend their money and pay cash for the product, and they just want to recoup some of their equity. We can do the exact same thing from the 6 to 12 month non-seasoned scenario on a 0 to 6 months. We're going to give you as much as what you paid for it, which of course you provide proof from the HUD settlement statement to show exactly what you paid for it, and we'll give you up to 70% loan to value there. And then of course we have our HARP program that just came out, HARP 2 should I just say, just came out in 2012, in March of 2012. Now a little bit about the HARP. It was established back in 2009 by President Obama. We had the HARP 1, which wasn't that successful. There was a lot of should I say limitations, and a lot of things, a lot of the loans were not successfully funded. And then they came out with the HARP 2 in March of this year, which has been outstanding. A lot of my investors have been taking advantage of this. The thing about it is you have to have a loan that was purchased before June 1 of 2009. That's one of the qualifications. And it does have to be either Fannie Mae or Freddie Mac. Some of the feature highlights that you're seeing on the screen, mainly for owner-occupied, there's some appraisal waivers, which you don't have to have appraisals done on the house, but generally on investment properties they do have to have appraisals done. So the best thing is, before you come to me or another lender to do a HARP program, you want to kind of get a general idea where that true value of the property is. A lot of times you can ask the agent that you might have worked with previously, or come to me, I can look up an AVM on that. So that gives us a clear interpretation of what the true value of that property is going to come in as an appraised value, because when we lock the loan, it's going to be predicated on the loan to value that we think it's going to be, whether it be an 85, 95, 105% loan. It has to be locked accordingly because there is some price variances.
So Graham, what you're telling me is I can get a loan for, or a refinance I should say, for 125% of my current appraised value?
That is correct.
So if I owe $125,000 on a $100,000 property, and my loan is currently at 7% because I got it in 2009, and today's rates are 4%, I could save 3% interest, or we're talking hundreds of dollars a month just by doing that refinance.
That's correct. That's correct. And one of the things that is really attractive because of this scenario is a lot of people will come to me and say, okay, I want to refi my home. And when I talk about any refinance, whether it be an owner-occupied, investment, HARP, whatever the case may be, Interest rates are important, but dollars and cents is still the most important thing. So if your current payment today can be improved by $100 to $150, either a large loan amount or a small loan amount, typically that's the threshold that, because there are closing costs involved, you're going to see a very short recoupment, and you're also going to see a positive income and positive cash flow.
Can I roll those closing costs into my new loan?
Yes, you may.
So for someone who's a cash flow investor and they've experienced a decline in value, there's no reason that they shouldn't apply for this HARP loan.
A couple little quirks as you see on the screen. One, if you bought a house, say 5 years ago, you bought it for $100,000 and you put 10% down, well, chances are you're going to have private mortgage insurance on there. And let's say there's been no movement in the values, and today it's still currently worth at 100, and you're still at a 90% loan to value. We can still do it if it's either a Fannie or Freddie, but the mortgage insurance carrier that's on the note has to approve the transference of their MI to the new loan, because you're still going to have private mortgage insurance. But on the other hand, if you bought a house for $100,000 and you put 20% down, now the house is worth $90,000. Well, you're above that 80% threshold. If you did not have private mortgage insurance, well, you don't have to have it today. I just locked a couple this week, 2 investment properties. One was 105%, another one was 107%. No MI, and they got I believe it was 4.125 on the rate. It's crazy. The other thing is, you may want to go back to that other screen. The other good point that a lot of investors don't know, because of the limitations that they've experienced in purchasing in today's environment, knowing that they can only go up to 10 loans, this particular product or this particular program does not have any limitations at all. If you've got some Fannie Mae and Freddie Mac loans existing in your portfolio today currently, and you've got 20 loans and they qualify, there is no limitations. We can still provide you with a loan. Your loan itself has to be currently owned by Fannie or Freddie. It has to be purchased prior to May 31st of 2009. The current mortgage cannot be refinanced again if you had taken advantage of HARP 1. So keep that in mind. So of May of 2009 forward, if there was another HARP refinance done, that you cannot take advantage of that. Current loan to value ratios must be greater than 80%. Last thing is, which is one of the most important things, is that the house has to be current with no mortgage lates in the last 12 months. And this is where a lot of people run into some issues that have been misguided from some of the servicers past, because they had loan modification programs available. People wanted to refinance their house. They may have been in dire straits. And some guy on the other end of a large bank may have said, well, you can miss a payment and come back and get a loan modification. Then, of course, they couldn't get it. So they've missed a payment. Now they want to do a HARP and they can't do it. So make sure that you're current on your last 12 months of your payment.
So Graham, if I wanted to figure out how many properties I could afford, I'm assuming I could call you up and give you my information, and you could help me understand how many properties I could afford?
That's generally the biggest question that new investors will ask. First of all, can I qualify for number 1? And if I'm looking to buy 3 or 4, can I apply for that as well? The answer is yes. As we discussed earlier, the Fannie Mae and Freddie Mac guidelines do require seasoned investors to have 2 years seasoning before we can give the income back to you on the subject, as well as other properties that are not on the tax return. That is not the case with the Fannie Direct program. We do allow for 75% gross rental income to be counted toward your income as far as the qualifying ratios. We also give credit for additional rental properties to be purchased at the same time. As an example, if you got 3 properties that you're buying at one time, and say one of them is, let's say they're all 3 $100,000, and they're all bringing 1% rent, so they're giving a $1,000 rent credit, and your payment with the principal, interest, taxes, and insurance is, say, $600. We're still going to wipe that $600 debt out, because we're going to give you 75% of the rental income. In this case would be $750. So we do help with the qualifying ratios even on multiple purchases.
Graham, tell me, how does someone go through the loan application process, and can you give me some of the do's and don'ts of how someone behaves or should behave during the loan application and closing process?
Well, let's just kind of go through the application process itself. Generally, give me a call, tell me a little bit about your equation. I can generally say, okay, well, that looks like we're going to be okay. I'm either going to take the application over the phone on the spot or have them directly go to my website. Once we've sent out the disclosure forms and we've sent out a needs list in accordance to the type of documentation that's going to be required to support the loan, once you have all that documentation prepared, ready to go, you can scan it, send it back to me in an email through a PDF. You can send it through my toll-free fax number. Third-party vendors will be ordered once we receive the documents and disclosures out, which in this case will be the appraisal, and order up any title work, depending on the state you're in, if there's any survey requirements. And then, of course, we're going to ask you to determine your insurance company. We're going to make a request to them as well. Once all this documentation is back in our office, the processor will organize the documentation and submit it to the underwriters for approval.
Graham, tell me who does what in this particular process. I mean, I know that there's a lot of paperwork that has to get to you, but tell me what kind of paperwork is handled by your team and what kind of paperwork and vendors are ordered by the actual buyer or borrower.
Good question, David. Actually, we take care of everything. The appraisal is ordered through our own in-house appraisal system. The title work we send directly to the title or escrow company. If there's any survey requirements, sometimes we'll order the surveyor. Generally, most of the time, we'll ask the title company to order that. Once they have identified the insurance company, we'll send a request to them as well. So they don't really do anything as far as the mechanics of third-party ordering. All they're asked to do is just provide us with the documentation that we need to support their income and asset information.
Graham, just so that we can help our new investors really understand, can you tell our listeners what is the underwriting process and the closing process? What do those terms mean and what really happens?
Being that we fund all of our loans in-house, we generally have all the services in-house as well. Processing, underwriting, legal, closing, everything is in-house, so it's all turnkey for us, which makes your world a lot easier. Once the loan itself comes out of underwriting and everything is validated and we've satisfied all the conditions, then those go through a compliance test in-house to make sure we're in accordance to all the laws. And then, of course, it's sent over to our in-house attorneys. They prepare the documents. Once the documents are prepared, those are emailed over to the title company. The title company will prepare all the documents for closing. Once they get those documents prepared, they'll also generate a HUD settlement statement, which is the bottom line for what you need to bring to the table for the transaction. They'll send us a copy of that settlement statement. We'll review it, make sure it's in line with the instructions that we've sent over. Once it's approved, the title company will be notifying you, because typically if you're out of a state lender, they'll be overnighting those documents to you for signatures, notaries, and then of course overnight it back. And then you'll be having communication with the title company at that point of how you're going to get the funds to them, whether it be a certified check or a wire, and they typically can give you wiring instructions.
Another interesting tip is that the loan documents are often prepared before the final HUD statement is prepared. And so I'll ask the title officer to email the loan documents as soon as she receives them, because they have to fund off of the original loan documents, but the HUD statement oftentimes can be faxed or emailed in, and they can close the transaction off of the electronic copy of the HUD statement, even though they need the original loan documents.
And that's really a great exercise, David, and a lot of people that are a little more thorough than others and want to have a greater peace of mind than others, they do like to review those documents a little bit more in advance. And sometimes some of the individuals would like to send those documents to their own personal attorney to make sure that they're confident that the docs are good. So that is a great way of doing it. We actually can do it from our end, or the title company can do it from their end. But once they have all the documentation and they reviewed it and they're comfortable with it, it makes the signing so much easier.
Graham, tell me about the closing and funding process.
Well, as I mentioned earlier, once the documents themselves have arrived at the borrower, they sign all the documentation, they get it back to us via overnight or via courier or via a local notary service that comes to your house. Once the docs are received back, many times via fax, Our closer and funder will take a look at all the documentation and make sure everything is in order, and then we'll generally give a funding number to the title company, and at that point the house is yours.
So Graham, you made that process sound so simple and hassle-free. Could you tell me where people kind of get hung up and they can make the process more complicated for themselves?
This is some of the things you don't want to do. Once we pull credit on you, we're never going to pull that credit again until we go to close, and we generally have that credit report good for 90 days. As we talked about earlier, if we have additional transactions thereafter, but we only have one credit report. There's a disclosure form that we're going to ask you to sign. That disclosure form says that you have not gone out to extend your credit any further than what you have today, which means once we pull credit and you decide to go buy a car, sometimes that can hurt you. And if you're changing jobs, people think, well, I'm going from one salary paid employed position to another. Well, there's some loan programs out there that does not allow for us to do that because you have to be on a job for a certain period of time. Please be forthright with me up front before closing if you're making any job changes whatsoever. Anything that changes from application to closing, address changes, change of employment, anything, please let us know in advance so we can prepare you and we can prepare the loan itself accordingly. Full disclosure is truly the key here. My job and your job is to write a book. And that book has to be a book that's going to be read real easy by an underwriter. There's going to be some chapters that may be required, some chapters that we should add. But it's my job to keep you out of harm's way. So the more disclosure, the more upright that you are and forthright with me about your whole world, that makes my job a lot easier. One of the other dues that I prefer that you at least give us the information on, there's a lot of times people want to do the entitlement of their loans into their family trust. The family trust is a pretty lengthy document. I've seen it 30, 50, 100 pages, but the document itself does have to be approved by our attorneys. It has to be a revocable trust, and we do have to review that, and typically we don't run into any issues with a revocable trust, but irrevocable trusts are not allowed. The other thing is on the documentation, if and I had an example just this week, a gentleman, he makes about $1 million a year, he's got several million in the bank, and he only showed us a checking account that had, say, $100,000, more than enough to do the transaction. But on the paper trail that we saw, he deposited $100,000 into his checking account, more than he had. But it came from his wife's deposit, or his wife's account, that his name wasn't on. Well, the underwriter is going to interpret that as a gift, which gift is not allowed on an investment property. So keep in mind, from the day of application to the day of funding, if you had any surgence in your accounts, or that you made some withdrawals from your accounts that look a little unordinary, the underwriter is going to call it out. So my advice to you is to save everything that you possibly have. If you're doing deposits and withdrawals, just hold me the paperwork on it.
Graham, you've done a fantastic job helping us understand how to go through the financing process, and I'm sure that people are going to have a lot of questions. So on today's webinar, we have the opportunity to handle a few general questions, but if you have a very specific question about your situation, what I would really encourage everyone to do is send us an email. Send it to david@hassle-free-cashflow-investing.com. And what we can do is schedule a time for you to meet with Graham and or myself, either separately or together, where we can really look at your financial situation and help you determine the best strategy for using financing as a way of creating profit for your family rather than using financing as a liability. Because as you saw in today's webinar, financing is a very powerful tool, and if you're trying to create any type of wealth that outpaces inflation, financing is really the secret sauce of what makes real estate exciting, what makes real estate powerful, and I really encourage everyone to reach out to say hello. So at this time, we're going to open the call up for questions. Thank you everyone for attending our webinar today, and I'd like to say a special thanks to Graham Parham at Prime Lending.
Thank you, David. It's been a pleasure. Once again, please don't hesitate to give David or myself a call if you have any questions whatsoever. Thank you.
We look forward to being a part of your power team and really encourage you to get involved in this amazing real estate market so you don't miss the boat.